This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
So thank you for joining us. My name is Bruce Norris, and today our special guest is Jordan Levine. Jordan is Vice President and Chief Economist for the California Association of Realtors, where he's responsible for the housing market and economic trends and analysis, policy analysis, and data work in a variety of contents. And he's as much of a nerd about stats as I am, so I'm excited to get to speak to him. He's done many other things with Beacon Economics and so forth, spoken in front of large audiences. And I just watched him last night, and I mentioned to him before we went on the air. It's just, it was a pleasure watching how much fun he had speaking in front of an audience. So Jordan, really glad you're here with us today.
Thank you so much for having me back.
You know what's interesting, and I'm going to go back to the end of 2019, because I'm going to kind of take that year, and then I'd like your explanation about something. So at the beginning of 2020, and that was when I heard you speak, by the way, when I watched it, we enjoyed record low unemployment. We had low interest rates. We had reasonable inventory levels. We had historically high affordability, virtually no competition from lender-owned properties. Despite that all being in place, real estate prices rose very modestly that year, and sales were about the same as they'd been for the last 10. So if you were speaking in that audience, in front of that audience in January 2020, how did you explain that modest year for real estate? Because it seemed like it should have done much better.
Yeah, definitely. And I think that, what we saw was that there was, still, even as we saw some new listings come online relative to where we were now, looking back at the beginning of 2021, it was still pretty tight from a months of supply standpoint. And we've had several years now of fairly low rates, and that has really put pressure on that available housing stock. So we didn't see enough homes turning over. We had lots of buyers who wanted to get into those homes. But I think what we've seen as well is that our kind of 30-year chronic underbuilding trend that we've done for so long starts to catch up with you when you're as late in the cycle as we were even in 2019, right? The economy had really hit bottom back in 2010, arguably 11, 12, depending on which indicator you want to point at. But we've had, not as low rates as we see today, but we've had fairly low rates persist throughout that time, and it really has just put a strain on, again, the amount of homes actually available out there. And so that's where I think the disconnect is between all those positive kind of nerdy macroeconomic indicators and the actual home sales.
What's interesting about that is what's happened now. So during 2020, now, emotionally, if you think, okay, how do you feel about 2021 versus 2020? It's like a different world.
Right.
So you can't be looking out at 2021 going, oh, I feel so good about all this stuff. So now we face lockdowns, high unemployment, uncertainty is honestly as high as I have ever felt it as an adult.
Right.
Despite that, California sales in 2020 managed to go up over 20%. At the same time, inventory went down by 45%. So prices, instead of declining because of all the uncertainty and all this other nonsense, went up 17%. So it's that's a head scratcher to me. Why 2020 and not 2019?
Right. Yeah. And I think that it's interesting because we were optimistic at the end of 2019. Rates were actually coming back down a bit. They had gotten up close to 4% or a little higher there, and we're on their way back down towards the end of 2019. We were forecasting that 2020 was going to be a good year prior to the pandemic because we saw that, all-time low unemployment, low rates, and all that good stuff. 2020 did end up being a great year for home sales mathematically, but for completely different reasons. And I think it wasn't those low cyclical, things like low unemployment, low rates that drove it. I think this crisis has been unique because it created some kind of structural component to the housing demand equation as well, where, our homes are more important to us now than ever before. You don't just go back there at 6, 7 o'clock at night, grab a bite to eat, and then lay your head on the pillow before you head out the next day. You need so much more from your home. It's where you live and play and where you're held hostage and all of that stuff for months on end. And so you need more space. That open plan condo doesn't work as well in the downtown when you and your spouse are both having like dueling Zoom meetings, right? And so I think that there's been some fundamental changes to our relationship with housing that's just kind of compounded all that macro stuff where unemployment's coming down and rates are low. But I do think there's been that kind of fundamental shift.
What was pretty cool to me is that you ended up getting 20% more sales out of 45% less inventory. So it kind of dispelled that where there wasn't enough houses, because in a way, the inventory levels, if they were low compared to demand, you'd have price pressure like you did this year.
Yeah.
But this is my take on, I'm just going to run this by you because I had to think about this, as I'm presenting in front of people going like, what the heck going on? I kind of think there were two urgencies that met. So I know the realtors that had listings in March, half of them disappeared.
Yeah.
People just pulled them. I don't want anybody looking at the house. And oh, by the way, I just refied a 2.5, so I'm staying.
Yep.
So maybe that home not coming back. You had the other group saying, I got to get out of wherever I am.
Right.
And so all of a sudden they became an urgency shopper. Wasn't like picky. I was just like, I got to get one.
Yeah.
And those two worlds collided that were urgent. I got to pull my stuff away and I got to have one at the same time.
Yeah, I think you're absolutely right. And I think, it wasn't that demand wasn't there before, but you could always kind of postpone it, right? We'll wait and see what happens with rates. We'll wait and see maybe prices come down. There's a lot of naysayers on housing out there and stuff like that. And so I think that you're absolutely right. Once you kind of, it's now or never, or rates are very, very low, the lowest they've ever been. And I have that fundamental need for my home. Well, that's a perfect storm.
Yeah, that's an interesting thing. You probably, maybe we put a report together with the title 2% mortgage rates on the front, and of all the silly titles that come true, that's one I'm happy it did, of course. But
right
when I remember I was on the phone with John Burns as the 10-year T-bill went below 1%.
Yeah.
I took a photo because I never thought I'd see that in my entire life, And then it goes down to like 0.4. I go, oh my gosh.
And it's still low today, and I think that we're looking at low rates for this year. That's why we're still pretty optimistic. I think the other thing that we didn't talk about is the flexibility, right? So if you look at the geographic distribution, that also is telling, right? Because it's also that people have a little bit more flexibility. Maybe you work like I did at a company who was very office based, right? We are very, the real estate business is still largely a face-to-face business. That's true of individual realtors. And so we reflect that as a trade association for realtors, and that kind of limits your options when you're going to that office every single day in terms of being able to achieve home ownership and maintain that kind of balance between quality of life and your commute time and all that stuff. Well, that's the kind of third leg of this stool that we're talking about with the low rates and the increased demand for housing, is that maybe now I can, look at things a little bit further east, or maybe look at the Inland Empire. You even see a lot of those resort communities doing really well. And so I think that we had an opportunity this year is kind of a weird way to the verbiage for it, but to do a better job of putting the people where the housing was. And I think that unlocks opportunity for an elevated level of home sales too.
Jordan, I have a quick question. Now, one of the things that we do here at the Norris Group is put out a quarterly economic newsletter, and we use a lot of your, CARS, stats.
Awesome.
We kind of had to wait because the pandemic kind of threw everything off. So, how did the pandemic affect your outlook, your predictions? How long did you have to wait, and is it still affecting? Is it still kind of up in the air?
It is. I think that, we had to make fundamental changes. So as an example, we've been, for 40 years or so, we've been doing monthly reporting, right? We get to the second or third week of the month, and then we let the dust settle on the MLS and gather all that stuff up and tell folks what happened, what the trends are, and what, are the areas growing and things like that. This was, days were like weeks and weeks were like months at the beginning of this crisis in terms of just so much uncertainty and trying to get our arms wrapped around this. We started going into every MLS every single day across the whole entire state. And so just the amount of data that we were having to chop and slice and dice through, the amount of automated processes we had to stand up almost overnight. We're talking about, exponential quantities of data that we're looking at, because we're used to going in 12 times a year, right? Or 13 times a year to do a re-benchmarking maybe. And then by, the first 4 weeks of the pandemic or so, we had already downloaded twice as much, transactional information as we would have in a normal year. And so that, required a lot from us, but what it did was it unlocked the ability to day by day go in and keep weekly tabs and monthly tabs on where we were compared to last March, April, May. And so very quickly we had a sense of just like what the bottom looked like in terms of orders of magnitude. We didn't know if it was going to be 150,000 home sales at first, or 300,000 or 90,000 or what. And so that was a huge, I wish I could take credit for it. My team actually stepped up to the plate and just did a Herculean lift so that by the 16th of March, we had a standing process that was hitting all MLSs in California every single day, so that we were able to aggregate that up at a statewide level.
Will you carry that forward?
We're going to keep that going forward, and we're still figuring out the best way to make that information consumable. Like, I think, the dream is to make even like a real time, or like as close to a real time indicator as we could get, so that when you go to, car.org or whatever, that it just says like, January 16th, we're up 3% month to date compared to where we started the year. And that's my dream, is to be able to do that and unlock the ability to drill that down to the submarket. So stay tuned.
Oh, there you go, Bruce. There's a ticker for you.
I've got a question for you on affordability, because year over year, where are we? We were in the low 30s, and then we got to, where are we now? About high 20s?
Yeah. High 20s. Yep. And we're still working on the fourth quarter number. The problem is predicting what happened with incomes, right? Because income data from the government is lagged. And so usually we're extrapolating out the most recent couple of quarters. And so now, usually that's not that difficult. You look at the unemployment rate, you look at the average wage numbers, which are more timely. You do some back of the napkin kind of analysis and build those historical correlations. But now you have real honest to goodness lost income. You've got the government monkeying around with the income numbers as well. And so it's been a challenge on affordability. But what we can see in the actual weekly and monthly data is, if you just look at straight up price growth, and then you combine that with the low rates, we can kind of get a sense of what's happening with typical monthly mortgage payments. And for the last 8 to 12 weeks, the effect of these higher prices is finally starting to cancel out the benefit of the low rates. Low rates are still a blessing, right? It's not going to kill off the market, but it used to be the fact that it was actually monthly mortgage payments were falling. So even as prices were going up, the reduction in rates was more than offsetting those increases in prices. And now we're going back the opposite way, as we've been in the double digits for the last 2 to 3 months.
What's always been interesting to me as I look at charts is that typically at the end of a cycle, we have 4 years of really strong sales. So 86, 87, 88, 89. I knew 2000, say 4, 5, 6 was a little skewed, but in other words, it was artificial, but you still had a lot of sales. Same thing happened at the end of the 70s. What's interesting about those rise in sales is they come at the descension as affordability declines. And that seems counterproductive, but the human nature kicks in, I think, sort of like a Bitcoin, if you will. I bet they didn't have any trouble selling Bitcoin at 39 until probably tomorrow. But when real estate's hot, does the emotion kick in and trump affordability if the lender would say yes?
Yeah, I think that there's, definitely a kind of herd instinct element to all markets, right? You see that in the stock market, and things are more volatile, because that's exactly what folks are trying to do, right? Is get ahead of the curve and beat everybody else. And so I do think that there's an element to that. I do think that there's more of a kind of steep supply curve, I guess would be the kind of econ nerds way of saying it, though, where, in housing in particular, there, the demand fluctuations are happening against a relatively fixed amount of housing stock at any one time. And so I think that tends to kind of magnify things. And so I think that, you have that, and then the low rates are creating real honest to goodness, purchasing power things. That's one of the kind of paradoxes of low rates, right? Low rates can show up in kind of one of two ways: that I buy the same price house and I save a bunch of money on my monthly mortgage payment, or more realistically, since we're at 2 months of supply and you've got all these buyers, I think mortgage applications are still up 20 or 30% from this time last year, that it actually ends up showing up as, I'll just offer more money because now I can afford to make a higher offer without, affecting my monthly debt to income ratio. And that's what's kind of fueling this 16 and 17% price growth, is that, buyers needed that edge because we were in such a competitive kind of marketplace, partly because of the low rates and those fundamentals and all of that stuff. So,
right. That's a good point. So not paying anything monthly for the overpricing, that pretty much it was a wash. I got a question. Do you think the momentum is going to continue?
I think that there is some strength to the housing demand. I think that it does have legs, particularly because some of it was, structural, was fundamental. Part of it is the improving economy, right? That we used to be at 16% unemployment. Now we're back down at 8%, low rates and all of that. But I think that at least some of the flexibility, I don't expect us all to be working in our spare bedroom for the rest of our lives, but I think at least some of the flexibility is going to be here to stay. I think it's a matter of percent, right? Are we talking about 15%, 30% half time in the office? It's going to be somewhere on a kind of sliding scale for different companies, but I think that give some legs to housing demand, because if you look at our survey research, which we've done survey research since the late 70s, we ask just fundamental stuff about the housing market, like, do you want to own your own home? Is owning your own home part of the American dream? And actually, for all the stuff you read in the newspaper about how millennials only want to live in condos and walk to Trader Joe's and all that stuff, you do see that they, once it comes time for those big life changes, which granted are happening later for folks than they used to. You're doing that stuff and you're getting married, having kids in your mid to late 30s instead of mid to late 20s. But once that stuff happens, they still want a house, right? They still want a backyard. They want a garage. And so I think that the reason why they weren't buying was because they didn't want to, pay an arm and a leg, essentially. And so when you have the flexibility again to look at other markets where there's more housing supply, or where affordability is in a bit better shape, or you have more of that balance between quality of life, and even our most affordable markets unfortunately aren't particularly affordable. I moved up to the Central Coast to get away from LA's prices, and it isn't cheap to live here, but relative to what you get for your money. And so I think you'll see a lot of that calculus playing out and ultimately resulting in this kind of upward shift, at least partially permanently, right, in housing demand.
When California's median price is about ballpark 700 grand, US is about 3.25. There's only a few times that we get past 200% of the national average.
Yeah.
And one of the things that happens is people migrate elsewhere.
Right. Yeah.
So do you feel like that's likely to occur, or it is occurring already?
It's already occurring. So we just got new numbers for 2020 from the Department of Finance. Well, we got two important numbers over the course of the last couple of weeks, I guess month now. One was from the census numbers, the census statewide population estimate numbers, which showed that California's population in 2020, at least on that July estimate, shrunk for the first time in over 100 years, right? Since they started recording data, I think back in the early, 1905 is maybe the earliest.
And that was including natural increases, birth over death?
That includes people having babies, exactly. And so that is a hugely significant number. Then we got the Department of Finance, which breaks down that headline number. So the Department of Finance still showed growth, right? If you look at theirs, I think it was like 0.16% increase, which is still the slowest, ever recorded. It wasn't the decline that the census found, but what it does do is it breaks down that number so you could see under the hood. And what you could see is that we had an acceleration in out migration. And these were numbers taken in July, right? So this doesn't include all the people who left in the second half of the year. So potentially could be even worse next year, but they had already accelerated to 260,000. And what you see is that the birth numbers have really started to taper off as well, right? And so, and the other side is on the immigration side, which didn't pump up the overall population number either. And so that's really the trifecta that kind of leads to the number that the census is reporting.
Would you say it's a fair statement to say that the only population growth that California typically has had in the last couple of years, and maybe for the next any number of years, would be birth over death and not gain of an adult through migration? Is that a fair statement?
Yeah, I think so. And I think ultimately what you're seeing is that the supply problem has now started to become a demand problem, right? It's primarily because of that stuff we find in our survey research. People want to own their own homes. And if they can't achieve the American dream here, they can do it somewhere else. And unlike the late 90s, right, where we were the only game in town if you wanted to work in tech or something like that, or biotech, or all these really high paying industries, there's a lot of other options for that type of employment in states where you don't have to spend $750,000 to get an average home.
When you look at, if you could look at the financial statement of the people that migrate here versus the people that leave California,
Yeah.
which one of those would be wealthier? The people that come or the people that leave?
We're not doing a good job of attracting too many people on net. We did see some tiny bit of in-migration actually at the top end of the very top end of the income spectrum, but most of it is kind of right in the sweet spot in terms of our labor force, right? There are people who are making like $75,000 to $150,000 a year. There are people who work in management positions, right? Or there are middle managers, are people who work in software companies, are kind of frontline people who do all the important stuff that you need just to have an actual society, right? Our teachers, our firefighters, our police officers, all that kind of stuff, our construction workers. You talk about, a kind of unintended consequence, right, of this housing crisis is we talk about how much supply we need. One of the biggest categories, if you look at it occupationally, is tradesmen, right? We're losing carpenters and plumbers and welders and all these skilled, folks that we need to actually bring new supply online. So the paradox is that by not building enough, we're actually putting ourselves further and further behind the eight ball in terms of our ability to build housing. I think if you look at the wealthy people, you do see those big headlines, right? Like Elon moved to Texas and all of that stuff. But I think the more affluent folks are the ones who can still afford to live here and kind of can stomach the trade-off between cost and quality of life, right? It's the folks who can't achieve the American dream that want to take off.
Net worth tax, like wealth tax, that's not a good formula for keeping those people.
Yeah, definitely. I think that there's, the kind of tax code could definitely use some looking at for sure. I think that, we have such a kind of progressive tax code that what you would think was you would see the exact opposite, right? All the kind of wealthy people bugging out. But I think that, eventually, and one of the interesting things, if you look at the demographics, not just in the income front, is that we don't get party affiliation, but there does seem to be some kind of, climate component, if you will, to the out-migration where folks are kind of just sick of the kind of way the state is run.
Okay. How do businesses view California?
I think that California has never been particularly business friendly, but the interesting thing is that you're starting to see a broader coalition of folks connecting the dots on the root cause of this. And so I think, if you look at business now, they're seeing this housing issue squarely as a workforce issue, right? And what's interesting, if you go back and look at studies by, super smart people like Jed Kolko's looked at firm migration and things like that, companies don't usually pick up and leave wholesale other states. But what we do see is that they expand in other states, right? That you might not see them close up shop at their San Francisco headquarters. But what you do see is that they have an HQ too, right? That they put in Virginia where their workers can actually afford to own a home and stuff.
Right.
And so I think that we've been saying this for a long time because it affects our members directly, right? When folks can't afford to buy and own their own homes, then the realtors can't do, the transactions for the demand that would ultimately be out there. But this is a deeper economic issue. California has always been able to grow faster than the United States for all of our kind of warts, right? Our business unfriendliness and our high taxes and all of that stuff. We were always growing faster than the rest of the state despite that, right? And even with no supply, we just saw prices keep going up and people still bought homes and all of that stuff. But I think that it's starting to again, I think the supply issue has just gone on for so long that it's starting to become a demand issue now.
Has the Amazonization of things had something to do with that?
I think that's part of it. I think also it's just part of the development of the economy, right? That success breeds competition, right? When you saw the tech sector blowing up, I mean, think of how much money and venture capital and all that has been thrown at, this, and that has happened outside of California. You see all kinds of stuff happening in Denver and Austin, Texas, and Seattle on the East Coast. And so I think that just, you can still have access to a really smart, up to speed workforce there. And I have just as an anecdote, or we call it anecdata, right? My niece graduated college and she had one of those fancy degrees that everyone wants, right? She did computer science and she was good at all that stuff. She got a job offer, as a 21-year-old kid to make, I think like 85, or I think maybe it was even more. It was like $100,000 a year or something like that to take a job in San Francisco. And she got an $80,000 job in Denver. And she took the $80,000 job in Denver because
that was a raise.
you can live as in a much more comfortable lifestyle. You don't have to spend $7,000 a month sharing a 2-bedroom condo with 4 of your buddies from college and just to be able to say that you have a 6-figure job.
To go back to the workforce a little bit, with issues of labor, how much of that is going to different industries? Like how many people are used to swing a hammer are going to go frack now?
Yeah, I think what's unfortunate is that we really are kind of hollowing out California's economy, right? And that's something that I really worry about, is that you're going to just push people into kind of either out of the state or into these really high paying sectors or high value add sectors, and then we're going to have just kind of like a service sector economy that takes care of the needs of everybody else who works in those industries, and we're not going to have an actual middle class. And as a result, we're not going to have those kinds of businesses. Right. And so I think that it goes back to this idea of being able to outperform. We've been able to persist and outperform despite all of our challenges. But I think we're getting to the point now where our chickens are starting to come home to roost. And you can see that even before this pandemic kicked in, right? If you start to compare like non-farm job growth or GDP growth, we used to be head and shoulders above the rest of the United States. And as housing affordability deteriorates and more people leave and businesses do their growing elsewhere, it's not that we stopped growing, right? California hasn't become this big economic disaster, but we're just no longer that kind of top 5 states in the nation that we used to be able to bank on.
Jordan, I just wanted to say thank you for doing this with us. I know that this last year has probably been the hardest year to take a look at anything and say, this is real, for one thing. We're going to talk next about unemployment.
Yeah.
Because I look at these unemployment numbers and then I see the jobless claim number and my math is not adding up. And so that's what we're going to cover next. Thanks for joining us.
Hey, thanks so much.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.